I have made 20% in the last 7 days on just one short-term investment idea, and I'm going to show you 4 others with returns from 10 to 138% and higher. Now, I know you're not supposed to be able to beat the market, and we love us some long-term strategies here on the channel, but if anyone tells you you can't make money on short-term investments, you tell them bullshit and watch this video. Hey Bowtie Nation, Joseph Hogue here, and it is the perfect time for this video. Each one of these short-term investment ideas relies on factors independent of the market, factors specific to each investment. And that means these are going to be a great way to take the market out of your portfolio. Find investments that can rise or fall no matter where the market goes. I'll be listing these short-term investments from the lowest risk to the highest risk-return trade-off, so make sure you check out that last investment for a potential of 3 or 5 times your money. As always though, you know we can't get started without that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now I know this first short-term investment isn't what you're here for, so I'm not going to spend a lot of time on it, but I bonds are arguably the best investments for investors right now. You buy Series I savings bonds directly from the Treasury, so there's no commissions or fees to pay, and these are paying a 9.6% rate right now. The savings bonds have a built-in inflation adjustment that recalculates every 6 months, so as long as inflation is high, these bonds are going to be an excellent return, and it's a guaranteed investment. They're backed by the U.S. Treasury, and you get returns free from any state or local taxes. Now, you are limited to investing $10,000 a year, and these do have a 1-year lockup period, but we're going to be needing that protection from stock prices for at least that long, and where else are you going to get that totally risk-free 9.6% return on your money? I want to get to those higher return short-term investments, but I'm going to link to a full video on Series I bonds in the description below. Make sure you check that out and take advantage of these. Next on our list of short-term investments is a deal arbitrage strategy directly from one of you out there in the nation. Asking Amy on her stock picks in our $1,000 portfolio challenge, she brought up the opportunity in recently announced acquisitions. Stocks like VMware and Activision trading for discounts of 10 and 20% from their acquisition price. And let me explain, because this is a great low-risk short-term strategy that can not only make you a lot of money, but help take that market crash out of your stocks. VMware, ticker VMW, agreed to be purchased by Broadcom in May for a price of $142.50 per share in cash or Broadcom stock. Shares popped 38% on that announcement to $132 each, but because of that broader stock market sell-off, have since fallen back to just $114 per share. This isn't like the Twitter acquisition that is going to be fought in court. Both sides have agreed to the purchase. It's a great deal for Broadcom, and there shouldn't be any regulatory issues. The deal is expected to close sometime after November, and shares of VMware are trading at a 20% discount to that purchase price. In another deal, game maker Activision Blizzard, ticker ATVI, agreed to be bought by Microsoft in an all-cash deal for $95 per share in January. The Federal Trade Commission is expected to approve this deal as early as August, and this is another stock trading below the deal value. You see in January where that stock jumped 28% to $82.31 after the deal was announced, but has since given back some of that to trade just under $79 a share. Now, it is typical for post-announcement acquisition stocks to trade under that agreed-on price, just on risk that the deal doesn't go through, but rarely do they trade at discounts this high. Even Activision, a deal that is a great buy for both parties and an all-cash offer, is trading for 21% below its acquisition price because the stock market is in such a funk right now. Even Twitter, which is trading 46% below the $44 billion buyout offer by Elon Musk in April, could be a great opportunity. Musk is trying to back out of this deal, but Twitter has a very strong legal case to either make him go through with it or pay a breakup fee greater than the $1 billion initially agreed. In fact, after the stock slumped when Musk tried to cancel, I picked up 400 shares of Twitter for just over $13,000 in one of my retirement accounts. You see here, I bought the shares at $32.86 each and sold call options expiring in January at the $40 price for $3.51 per share. Now that lowered my cost to $29.35 each, a great price for Twitter no matter what happens. I have made 20% in less than a week on my Twitter shares, and I'm going to make 36% on that 6-month strategy if they trade over $40 a share in January. And since it's in an IRA account, I won't pay the income taxes that normally hit these types of short-term investments. Now you will notice something looking at that Twitter position at about $12,000 total cost. It's got the potential to earn me over $4,200 in profits at a great return, but but not break me if something heads south. Nation, even those relatively safe deal arbitrage stocks we just looked at are going to be risky, so I'm not saying put all your money in these short-term investment ideas. As a rule of thumb, I try to spread my risk across 3 to 5 short-term investments at a time and have no more than 10 or 15% of my total wealth in these. That means if 1 or 2 investments don't go my way, I'm down only maybe a few percent on my portfolio and still have those others to produce those double-digit returns. Now, staying on top of these opportunities means following the news closely, so I want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market's news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign up link below. Our next short-term investment idea could be a triple-digit return on copper prices. The price of copper has plunged 33% from its peak in March, and futures prices are trading right around the point before they made their big jump last year. Now, copper is an industrial metal. It's used in construction, alternative energy, and infrastructure, and that just means that fears of a recession and economic slowdown are going to hit this harder than some other metals, and it's a given that the price has come down. But it wasn't even a year ago that analysts were calling copper the new oil and calling for prices as high as $20,000 a ton. And the issue here is not only that massive demand from copper in traditional construction and infrastructure, but the booming demand that we're seeing in energy and electric vehicles. The average vehicle on the streets today holds just 51 pounds of copper, less than a third the amount needed for a battery electric vehicle, and just 2/3 the need for a hybrid vehicle. And this chart shows the current and planned production for 3 key elements in those electric vehicles. Dark blue here is the current operating production, with light blue including planned projects. Now, on that red line, the increased demand from electronic vehicles, we could be in a supply deficit by 2024 in copper and even earlier in some of these others. Now, there are a couple of different ways you can play this, and that goes for most of these short-term investment ideas. I want to show you how to take advantage of these with different levels of risk and return, whether it's buying the stocks, the options, or strategies in the futures market. For copper, the Global X Copper Miners ETF, ticker COPX, has plunged on those recession fears, but it's a 67% return potential back to its March peak and pays a 2.9% dividend yield while you wait. Now, I doubt copper gets back to its peak within a year, but any sign of an economic rebound and these shares are going to jump. Another way to play this would be through a call option spread. That's buying the January options for a $25 strike and then selling the $30 call options for a total cost of $2.50 a share. If the COPX trades between $25 to $30 by January, then you're going to get those shares at a discount for $27.50 each. If they trade over $30 each, you're going to have doubled your money. Now, options investing strategies do involve a lot of risk and are more complicated, so I'm going to link to a full video of my 5 favorite strategies in the description. I like just investing in the copper ETF shares as well, though, because you're going to get that 2.9% dividend, plus it's a great long-term investment, even if we don't see a quick short-term bounce. And that's really one of the 3 things I'm looking for in any of these short-term investments. First is, what is the likelihood of those positive returns? For example, the rate on I-bonds is guaranteed, and those deal arbitrage stocks are a very high likelihood. Second, is there potential for a much higher return? If I'm going to be taking big risk in some of these, I want to see a big return potential. And third, what's the outcome if the investment doesn't go my way? And for this, I'm looking longer term out. If the investment doesn't produce those higher returns within a year, can I feel comfortable holding it for longer? Is this a long-term investment thesis just as strong as that short-term potential? Short-term investment idea number 4 is a play on the multi-decade high in the value of the dollar against these other currencies. The value of the US dollar has reached a 20-year high against the Japanese yen, and it hasn't been this strong against the euro since 1986, a 36-year high. And the big picture fundamentals are supportive of a stronger dollar. The Federal Reserve has been more aggressive at raising its interest rates compared to other countries, especially the Bank of Japan and the European Central Bank. You see higher interest rates in one country pull investment dollars from abroad just as investors look for that higher yield. They buy treasuries and other investments denominated in dollars, so that dollar demand pushes the value up. While inflation is at a multi-decade high here in the US, it's still relatively less than many other countries. Now, a high inflation rate devalues a currency versus others, eating away at how much you can buy with a dollar, a euro, or a yen. Inflation in the Eurozone hit 9.6% in June, and it's surging in emerging markets like Turkey, where prices have jumped 79% in the last year. And I know all this economics talk is probably only exciting to nerds like myself, but the stronger dollar is starting to have some real-world consequences. It makes exports more expensive, so any company producing in the United States to export abroad is getting hit. A strong dollar is also hitting the earnings of companies with sales in other countries, especially tech companies. Now, that dollar strength is going to start being politically dangerous as we head into midterm elections, and as the economy weakens into a recession, that should also weigh on the dollar over the next 6 months. Besides those factors, it was only just last year that many were warning on the destruction of the dollar against record high deficits. Use of the dollar as the world's reserve currency has fallen steadily for more than a decade, falling to below 60%, even as currencies like the yen and the Chinese renminbi gain in usage. Now, all this means is that the days of runaway dollar strength could be numbered. I've talked about using the futures market to play this in the past. For example, here we see the euro futures on the CME exchange have plunged from $1.14 per euro since the beginning of the year down to $1.02 per euro right now. And the beauty of foreign exchange futures is the leverage you get. Each futures contract is for 175,000 euros, an amount few investors would be able to put up. But you only need a fraction of that. The margin requirements on most brokers is 2 to 5%, which means you may only need $3,500 to start this position. Let's say you put down 5% of the contract, invest just $9,000 to buy one futures contract on the euro. If the value of the euro increases even to $1.06, where it was just last month, that's an increase of just 4% in the value versus the dollar. But because of that 20 to 1 leverage, you will have made $6,800 or a 75% return on your investment. I realize futures is way beyond what most investors want to get into, but there are other ways you can play this short-term idea. The currency shares Japanese Yen Trust, ticker FXY, is down 18% since the dollar started strengthening in January. The fund uses the futures and options market to give you that same dollar-yen exposure and will rebound on any dollar weakness. There's also the currency shares Euro Trust, ticker FXE, which does the same thing on that euro-dollar pairing and is down 12% since the beginning of the year. Now, both of these funds have options available, so you can even amplify your returns with a call or a spread strategy if you want that higher upside. I'll reveal that best short-term investment idea next, but if you want to see the 11 stocks I'm buying and holding forever, check out the video in the description below. The best buy and hold stocks in each sector for long-term returns. Our highest short-term return investment, you can play one of two ways with a leveraged fund on the NASDAQ index. Now, I've got two options for you here depending on your outlook for stocks. The ProShares Ultra Pro QQQ, ticker TQQQ, uses options and swaps to return 3 times the daily return on the NASDAQ 100 index. You can see on this day, when tech stocks in the NASDAQ jumped 3%, this fund boomed 8.75% on the day. So here, if you think the market can recover and those volatile tech stocks are going to make up some of that 30% drop from the peak, this fund could bounce 200% to retake the year's high. Now, on the other hand, if you've got a bearish view, you think stocks may be heading lower, then you could buy the ProShares Ultra Pro Short QQQ. That's ticker SQQQ. This fund uses those swaps to return 3 times the opposite move in the NASDAQ. So if tech stocks drop once again, this fund rises. You can see here, while the fund has come down with that rally lately, it was up 135% in the first 6 months of the year. Now understand, these are not good funds for a long-term investment. Both charge an expense ratio of nearly 1%, which is very high, and they don't track the NASDAQ as well on a long-term basis. Over the short term though, especially if you've got a strong view on where the market's going to go, these can be excellent investment vehicles. And if that leveraged return isn't enough for you, both of these funds have those options available, meaning you can get an even higher return. For example, buying the September $30 calls on the TQQQ and then selling the $35 call options would cost you a net $2.10 each, with a max upside of $5. That's a 138% return if the fund price rises just 16%, or if the NASDAQ index rebounds just 5% in 2 months. Click on the video to the right for the 11 stocks to buy and hold forever. Long-term investments you can make that beat the market. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.